West Pharmaceutical Services is not a household name, but every one of us has likely used its products without even realizing it. With its roughly 3 billion in annual revenue, West is a goliath in a small but profitable and quickly growing market. There are plenty of reasons to believe the company's position is firmly entrenched. We here at Sifter Fund invested in June 2022, so let's dive deeper why we choose to do so. What makes it a quality company? Why it is suitable for the Sifter portfolio? The identification of a quality company always starts off by looking at the numerical facts. These tell us whether the company has demonstrated the ability to produce superior financials, at least historically. Seen here are some key measures of West's historical numbers. Exceptionally notable is the high growth combined with a strong operating leverage, resulting in a massive annual net income growth of over 30%. This is, in short, the first step in our work process that gives us a reason to believe the potential candidate is worthy of further investigation. However, numerical superiority indicators are only backwards looking. And therefore, the heaviest workload for a quality investor is to study the company's qualitative advantages. Essentially, we assess and calculate the firm's ability and likelihood of producing the same or better financial profile in the future as it has done in the past. Shown here are some typical qualitative advantages we may find in a candidate, which explain its superior performance. A study like this typically takes weeks to months, and next I'll summarize our key findings on West and its qualitative superiority factors. West designs and manufactures drug packaging and delivery products for pharmaceutical companies. More precisely, West's products are the rubber components that come into physical contact with the drug, such as the cap, stopper, seal, and plungers. Now, at first glance, these might seem like commodities, low-value products that ought to be mass-produced in a low-cost country. But since this is the pharmaceutical industry, there is a catch. That catch is, of course, that it is of utmost importance that whatever touches the drug does not interfere with its safety and efficacy. Consider that pharmaceutical companies spend billions and closer to a decade on developing drugs, bringing them to market as soon as possible to get a return on their investment. If the drug must be pulled from market due to contamination from a low-quality rubber stopper, that's a massive waste of resources and opportunity. West's products, although a tiny fraction of the final cost of the drug, from a couple of cents up to $1, are a small but critical piece of the puzzle that ensures pharmaceutical companies can sell safe and effective medicines. Let's now take a closer look at West's business model. West has two business models: contract manufacturing and proprietary manufacturing. Contract manufacturing is roughly 15% of the business in terms of revenue. It is a reasonably stable but uninspiring business, where West manufactures medical devices based on its customers' owned intellectual property. West is, for example, the world's largest manufacturer of insulin auto-injectors. The proprietary business is, however, where the magic happens. The graph depicts the main products that West offers pharmaceutical manufacturers. As we move to the right and up, the value and customer intimacy increases. And from an income perspective, the sales price and margins increase. West produces a lot of simple rubber components, roughly 40 billion pieces annually. This is the lowest value offering, a standard simple rubber component. But these pieces are not ready to be fitted into the vial or syringe just yet. Somebody must wash, sterilize, coat, and inspect them. Over time, as drug manufacturers have looked to drive down costs, reduce non-core operations, and maintain consistently high-quality components, West has been positioned perfectly to take over this value-add process from its customers. Through performing increasingly high value-add to the simple rubber components, West has carved out a profitable business. And again, for the final price of the drug, the cost of West operation is a rounding error. But customers' drug quality cannot be jeopardized. Now, it wouldn't be a Sifter business if just anyone could do it. So what are the entry barriers? If the margins get too attractive, what's stopping the competitors from entering the market? The answer is the quality risk of switching supplier, technological expertise, and resource requirements to build out manufacturing facilities. However, the biggest barrier to entry is called the drug master file. The goal of regulators around the world is to protect the consumers by ensuring the safety and efficacy of drugs. Therefore, very strict regulation requires pharma manufacturers to specify the methods, facilities, manufacturing controls, processing, and of course, the drug packaging components. In essence, they are required to lock in a recipe for how to make the drug. While changing the recipe is theoretically possible, it is a very costly process requiring testing and reapproval from the authorities. Therefore, drug manufacturers are in practice hesitant to do so, especially for components whose costs are counted in cents per finished product like West's products. So, West has seemingly carved out an attractive niche for itself, but is the underlying market growing? To answer that, we must look closely at the end market, meaning the pharmaceutical industry. A high-level distinction can be made between two major classes of drugs that make up the over trillion-dollar pharmaceutical industry: small molecule drugs and large molecule drugs. Small molecule drugs are the class of drugs that first comes to mind for most people. Pills that are orally consumed treat an endless variety of ailments and diseases like simple painkillers. The market growth has been driven by simple factors such as population growth and increasing access to healthcare in developing countries. Large molecule drugs are, as can be seen in the graph, expected to be the growth engine of the wider industry. These are biological drugs, complex molecules made in living cells. Biologic drugs already make up most of the best-selling medicines treating age and lifestyle-related diseases such as cancer, autoimmune disorders, and diabetes. A catch of large molecule drugs is that they cannot be orally consumed, but are generally injected. These drugs are also generally more susceptible to contamination and sensitive to heat and light. These factors further increase the demand for high-quality, purposefully designed rubber components. Although West dominates the drug packaging industry with a roughly 70% market share, it is not the only supplier. Datwyler and Aptar are two formidable competitors with significant elastomeric expertise. So, what competitive advantages does West have over these players? Thanks to West's leadership position, the company is at the forefront of solving customers' newest and most demanding challenges and anticipating future needs. West can then apply this accumulated knowledge to serve subsequent customers facing similar issues. This expertise advantage is visible to us because West has shown an almost monopolistic participation in helping pharmaceutical companies bring the demanding injectables drugs to market. Secondly, as the largest manufacturer, it has the most significant global manufacturing facility footprint. As a reminder, the components are not interchangeable, so choosing a supplier is done with utmost of care. West can best secure supply chain resilience in this regard. And lastly, choosing a company like West that can fully support you from the startup to commercialization and whose products have been tested more than anyone else's is an attractive prospect for risk-averse pharmaceutical companies. Finally then, we have to consider the risks. What could hurt this business? The general answer is that anything that would reduce demand for drug packaging, especially high-quality packaging. The mRNA-based COVID vaccines are in fact biologic drugs. And as you should be able to deduce by now, the explosion in demand resulted in a considerable boost to revenue and profits for West in 2020 and 2021. The rapid slowdown in COVID vaccinations will be a headwind for the next few years. And from an investor's perspective, the company's valuation is on the high end of our portfolio. The market is not oblivious to the company's enviable position. In summary then, why did we choose to invest? The fundamental strength of West's business is, without a doubt, very attractive. It has dominant competitive positioning in a growing, profitable industry with multiple high entry barriers. The products are critical, yet a tiny fraction of the final cost of the products, which are in demand regardless of economic conditions. The company's management is experienced and consistent, growing nearly solely organically and preserving a clean balance sheet with a net cash position. We therefore see BEST as an investment that should compound earnings beyond short-term headwinds and reward the long-term investor.